Hello and welcome to Key Factors for the week starting November the 27th, 2011, providing the context for all our videos on MarketVisionTV.com throughout the week. Well, following a week where Europe has maintained a new phase of the projected debt fallout, begging three key issues. The first key issue is the severity of the crisis. The market is still underestimating the impact of the fallout. The continued stream of buy the rumour, buy the fact hope rallies appears to be now drying up, replaced by the news about the consequences. It's the investment and, in the long run, economic consequences that are important, which is reflected currently by the dangerously high level of European bond yields. In a week where Finland bought the Eurobonds, the S&P downgraded Belgium, but more dangerously, that Greece wants more help and a bigger haircut. Our forecast for the DAX at 4,000 by March remains a driving force and a reflection of how bad all things European are. The second key issue is the impact, as the effect until now has been surprisingly limited. The euro has been held at an artificially high level in our opinion, where disbelief about the severity has been suspended. Markets have very long-term memories, but traders have only short-term memories and often forget the extent to which a market may have to move to reflect a fundamental shift. Indeed, the market is only now really starting to recognise the real threat to the euro and all asset markets, as reflected by some moments of extreme short-term sentiment this week. But despite these moments, it remains a trader's and not an analyst's market. It remains in a dangerous ratchet. The definition of a ratchet is a steady but overlapping, erratic downtrend or uptrend without momentum. Curiously, the urban definition of ratchet is something that is out of control. There is only one level where the weight of money on the euro will match the weight of bad news, where the market will accelerate, where it will be out of control. And as my colleague Don Haynes and I will continue to highlight this week, there is only one level. Until then, we will sell European rallies against the three safe havens. The first, the dollar, is reflected by the dollar index, which continues to follow the now 1996 analogy. Against the Swiss franc, that despite the peg and the gotcha rumours like we saw on Friday, it will take on the Swiss National Bank, as highlighted in one of our videos this weekend. Euro-Swiss continues to follow a familiar path from 2008, where a sharp blowout on the downside was unwound quickly with a sharp recovery and then died a death. And thirdly, the yen, which remains subject to the spiral, or perhaps better named Mandelbrot analogy, and therefore, having returned to the lows, is now subject to an intervention-style rally in the short term. We will continue to sell European rallies and to a less extent sterling, but for how long? The key issue is the extent. How long, how deep, and how wide will this crisis go? Despite central banks and governments around the world, it is already longer in time, but not as deep as yet as we thought. One ironic reason is that the fear of contagion. There's a simple equation for contagion, for once, twice, thrice removed effects. Severity times impact. In other words, how bad and how much money is at stake? A question the commodities have benefited from in the financialization of commodities over the last year or so, and which now makes them vulnerable as the market continues to deleverage. Oil continues to map out that massive and prolonged triangle consolidation that still provides more downside than upside. Gold and silver did fade the rally to signal deeper retracements within broader consolidation ranges. So this does continue to spell trouble for the commodity currencies, Aussie and Canada, but more so Aussie. Long before this all started, when we highlighted the impending euro crisis, we also projected a subsequent Asian crisis, most likely through the longer-term economic and investment consequences of a European crisis. So we expect the Aussie to suffer more than most, and certainly the Canada, which continues to track the dollar index in its analogy from a time when the crisis eventually faded and eventually led to a recovery which saw the US bond yields rally strongly, saw the US dollar become risk on and rally, and saw the stock markets rally as well. It's funny how the markets forget. So there are plenty of opportunities in this market, short, medium and long term. To find out where and when, join us on MarketVisionTV.com or me, Ed Matz, on Twitter. Good luck and of course, have a great week.